Welcome to the channel. Today we transform the way you think about high-interest debt and investing. Instead of trading guaranteed losses for speculative gains, we'll show you a clear, math-first roadmap to stabilize your finances and accelerate wealth building. First, we'll set expectations and show you why paying off high-interest debt is a guaranteed return. Then, we'll map out a step-by-step plan to build an emergency fund, leverage tax-advantaged accounts, and use credit cards to build credit without paying interest. Finally, we'll test your knowledge with a couple of quick quizzes and wrap up with key takeaways you can implement today. Let's begin. Here's the roadmap for this video. First, we'll break down the mathematics behind high-interest debt as a guaranteed negative return. Next, we'll cover an immediate action plan that starts with a small emergency buffer, then rapid debt elimination, and optional refinancing for better rates. After that, we shift to building your financial fortress with a full emergency fund and tax-advantaged investing. Then, we'll optimize your credit profile using no-fee cashback cards without paying interest. Finally, we'll reinforce learning with quick quizzes and close with practical key points. Let's move into a brief disclaimer to set the stage. This content is for educational purposes only and does not constitute personal financial advice. Your circumstances, goals, tax situation, and risk tolerance may differ from the examples used here. Consider speaking with a qualified financial professional before making major financial decisions. With that foundation set, let's unpack the core rule that drives the rest of the plan. Here's the core rule. Stop trading guaranteed losses for speculative gains. If your debt interest rate exceeds 10%, immediate repayment is a financial imperative, not merely advice. In simple terms, high-interest debt is a guaranteed negative return. Every dollar you carry at a high rate is a dollar losing value at that same rate. If you hold savings while carrying high-interest debt, the math says to eliminate the high-rate liability as soon as possible. In the graphic, we contrast a typical high-interest debt rate against a reasonable expected investment return. The debt cost dwarfs the expected gain, making the decision clear. Next, let's visualize the decision flow so you can act with confidence. This flowchart starts by asking whether you have debt with an annual percentage rate above 10%. If yes, the first move is to keep a 2-month liquid buffer for emergencies, then direct all excess cash to repaying that high-interest debt immediately. There is an optional branch to explore refinancing to a lower fixed rate if fees and terms are favorable. If refinancing helps and does not delay payoff significantly, proceed, then continue rapid repayment. If no high-interest debt exists, the path shifts to building a 6-month emergency fund, maximizing tax-advantaged accounts like a Roth-ira and any employer 401k match, and then using no-fee cashback credit cards while paying the balance in full every month to build credit history without interest. Now that the decision framework is clear, let's translate it into a concrete, step-by-step plan. Begin by building a mini emergency buffer equal to about 2 months of living expenses in liquid cash. Next, direct all excess cash to high-interest balances, prioritizing the highest APR first, or using a consolidation if it clearly reduces total cost without extending the timeline. Consider refinancing only if it reduces your overall cost and does not add risk or delay payoff. Automate payments to prevent missed due dates and maintain momentum. Finally, track progress weekly, focusing on balances, interest saved, and estimated payoff time. With an actionable plan in place, let's examine the math with a quick side-by-side example. Let's compare two scenarios with $20,000. Paying off debt at an 18% APR saves roughly $3,600 in the first year. That saving is effectively a guaranteed return equivalent to the interest rate you're no longer paying. Alternatively, investing the same $20,000 at an expected 8% might earn about $1,600 before taxes, while you still owe roughly $3,600 in interest. Net, you're behind compared to the payoff route. Therefore, the guaranteed return from eliminating high-rate debt is superior. With the math clarified, let's test your understanding with a quick quiz. Question: if you carry a 15% APR credit card balance and expect an 8% market return, which action is mathematically superior right now? Options: 1. Invest in the market for 8% expected return. 2. Split half to investing and half to debt. 3. Pay down the 15% balance immediately. 4. Wait for rates to drop before acting. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is to pay down the 15% balance immediately. Eliminating a guaranteed loss at 15% is superior to pursuing an expected return of 8% that is not guaranteed. This is the essence of prioritizing mathematical certainty over speculation. Next, let's detail the emergency fund strategy before and after becoming debt-free. In Phase 1, while you are paying off high-interest debt, maintain a 2-month buffer in a checking or high-yield savings account. Once you are debt-free, scale up to a full 6-month emergency fund, also in a high-yield savings account for safety and liquidity. Keep these funds liquid and consider FDIC or NCUA insurance where applicable. Separate them from daily spending and consider naming the account something like emergency only to reduce the temptation to draw from it. Now, let's place these steps along a simple timeline to visualize the progression. This timeline shows the progression from immediate stability toward long-term resilience. Right away, hold a 2-month cash buffer. Over the next several months, eliminate high-interest debt aggressively. If refinancing can reduce total cost without delaying the payoff, incorporate it during the early months. After the debt is gone, expand the emergency fund to a full 6 months. Concurrently and ongoing, maximize Roth-IRA contributions and other tax-advantaged accounts. And use no-fee cashback credit cards, paying in full monthly to avoid interest while building credit. With the roadmap clear, let's refine your refinancing strategy and common pitfalls to avoid. Refinance only if the new arrangement yields a materially lower APR, preferably with a fixed rate, modest fees, and a term that is shorter or equal to the current remaining term. Avoid teaser rates that reset higher, high origination fees, and extensions that increase total interest over time. Do not let refinancing become an excuse to slow down repayment. Always run total cost math that includes the interest, fees, and time to compare apples to apples. Next, we'll compare using a cashback credit card the right way versus the wrong way. On the left, we have best practices. Use no-fee cashback cards for routine spending. Pay the statement balance in full every month. Automate payments and alerts, track rewards, and keep utilization low, ideally under 30%, to build credit responsibly. On the right, the pitfalls. Do not carry a balance and pay interest. Do not overspend just to chase rewards. Avoid cards with unnecessary annual fees or hidden charges. Never miss payments for the sake of your credit score and future rates. And do not use credit to support lifestyle inflation. With credit behavior clarified, let's reinforce the emergency fund sequence with a quick quiz. Question: what is the recommended sequence for emergency funds in this framework? Options: 1. Build 1 month, then invest everything. 2. Keep about 2 months now, then build to 6 months after becoming debt-free. 3. Build 12 months before paying off high-interest debt. 4. Skip emergency funds to speed investing. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is to keep about 2 months of expenses as an emergency buffer while paying off high-interest debt, and then expand to a full 6-month reserve after you become debt-free. This sequencing keeps you protected from common setbacks while maximizing your guaranteed returns from debt elimination. Next, let's present a compact, markdown-style checklist you can use immediately. Use this quick checklist to guide your weekly actions. First, confirm that you have a 2-month cash buffer. Next, direct all excess cash to any debt with an interest rate exceeding 10%. Consider refinancing only when it clearly reduces total cost. After the debt is gone, expand the emergency fund to 6 months. Then, maximize contributions to your tax-advantaged accounts, and continue using no-fee cashback credit cards while paying in full each month. To deepen the mental model, let's map the pillars of your financial fortress. This mind map centers on the concept of a financial fortress. The emergency fund branch covers the initial 2-month buffer and the eventual 6-month reserve in a high-yield savings account. The debt branch emphasizes paying any obligation above 10% APR immediately and refinancing only if it truly lowers total cost. The investing branch prioritizes Roth IRAs, employer 401k matches, and low-cost index funds for long-term compounding. The credit branch highlights no-fee cashback cards, paying in full monthly, keeping utilization low, and building a strong credit history. With the pillars visualized, let's capture the most important takeaways. These are the core takeaways. High-interest debt functions as a guaranteed negative return, so eliminate it first. Maintain about a 2-month liquid buffer while paying down debt, then expand to 6 months after becoming debt-free. Refinance only when it lowers total cost without slowing the payoff. Once free of high-interest debt, maximize contributions to tax-advantaged accounts like Roth IRAs and 401k matches. Finally, use no-fee cashback credit cards while always paying in full to avoid interest and build a strong credit profile. To close, here's a concise summary of the entire flow. In summary, the path is simple and powerful. First, stop guaranteed losses by eliminating any debt with an interest rate above 10%. Hold a small buffer while you repay, and expand it after you are debt-free. Refinance only if it truly reduces total cost without extending the timeline. Build wealth through tax-advantaged accounts and low-cost, long-term investing. Use credit cards as tools for rewards and credit building, never as a source of interest-bearing debt. Before we close, let's make sure you know how to keep this conversation going and support the channel. Thanks for watching. If this video helped you, please like it, share it with someone who needs a clear plan, and subscribe for more deep dives on building financial stability and long-term wealth. Drop your thoughts, wins, and questions in the comments so the community can learn together. See you in the next one.